Well, good morning, everyone. Let's try that again. Hang on a second. Test. Still getting an echo. There it is. That's it. It's always some stupid tech thing, and eventually you get it fixed. Let's try that. All right. Is the echo gone for everybody? Sorry about that. And we're recording. Isn't that exciting? Welcome back to IQ, Monday, August 19th. I've quite a bit to cover with you, and we'll try to do it in a reasonable amount of time here. Thanks for joining me, John Hutchinson with Traders Reserve. And big question this week, how long will this rally back last? The S&P has, to this point, recovered pretty much 7% of the top-down decline from mid-July through early August. So that looks good. The biggest difference in the last roughly 8-10 trading days, the market moving higher on good is good data, or inline is good data, especially from the PPI and CPI reports last week. Jobless claims falling once again. So the "oh my God, the world is ending" panic from early August has subsided. But the key thing to watch for me right now are the zeros. So 55, 54, 53, et cetera, even 56 to the upside. Those are going to be the key support and or resistance lines in the weeks ahead. Don't be surprised if we have a minor reversal as Wall Street sort of has to find its footing again. But at a minimum, positive 2 weeks. And I think this week will have a little bit of risk to it in the latter half of the week. I have that listed out in the 3 bullets on the left side at the bottom here. I'm going to talk a little bit more about the housing market in a moment, so I won't belabor the point here. But we have both existing home sales and housing starts data on tap later this week. The flash PMIs, which will either confirm or not confirm the direction from the July numbers. Remember that manufacturing fell deeper into correction in the month of July. So the question in the middle of this week, when flash PMIs come out, that's basically a first read, a temperature check on both manufacturing and services. We need to see those numbers pop back up a little bit. And services simply needs to be no worse than it was last month. So that has the potential to lead to a reversal. I believe those both come out. The flash PMIs come out on Thursday, so Thursday could be a busy day. And then the Jackson Hole Conference, Powell will be speaking on Friday. The expectation is that he will basically wave the rate cut flag to the market. But the biggest question is, and I don't expect Powell to give any indication of this whatsoever, is whether the Fed expects to cut by a 1/4 point or a 1/2 point. My money would be on a 1/4 point cut. The Fed has not shown themselves to be, I don't know, I guess, over aggressive in their approaches here. They've been steady. Whether we like it or not, whether we agree with it or not, doesn't really matter. But they've been consistent and steady in the execution of their policy, and their dot plot projected a 1/4 point cut for September. I don't see any reason why they would change that, even with the slowing of the economy. They will have the potential to cut again in November and or December. I've seen extremes out there up to a 1.5 point rate cut by the end of the year. The data doesn't support that yet. The economy may be slowing, and we've talked about this over the last several weeks. Economy is slowing, and by any measure, but it's not in recession. It has not fallen into recession, and that's sort of the tipping point, I think. The both services and manufacturing would need to fall into a state of contraction for the Fed to be more aggressive in rate cuts. So at a minimum, Powell's speech should just confirm that what the market already knows. So that unless there's a surprise, I don't see that as being a market moving event. But we always have to hedge for the potential for that surprise. So those are the main things that should move the markets. But your market action is really going to be late in the week. Look for Thursday to Friday. If there's any surprise, it's going to come out in those couple of days. Next up, I want to go back to the housing market. I've been pulling some data over the last couple of days. And there are a number of reasons throughout today's update. The first is based on Vice President Harris's economic policy speech last Friday in North Carolina. A couple of housing initiatives in there. We'll cover those in a few minutes, not necessarily in depth, but in the risks and benefits section. But I think it's worth looking at the housing market from an investing perspective, from where we are right now and where we may be in a year to 2 years. And on the sales side, right now the housing market, to my eye, faces a demand problem. Sales have been falling consistently since early 2021. You can see that on the new homes and to a degree on the existing sales. Existing sales really started to fall off in 2022. But existing home sales right now are kind of the roadblock. And it is, you now have a 4-month supply of existing homes, and existing home sales have reached a 10-year low. And lower even than the pandemic spike, the low spike during the early stages of the pandemic. So that's a concern. And the new home sales have retreated more to an average, but that means that there's a demand issue that's causing a blockage in the housing market. Another point as it relates to the Fed is that housing, whether owned or rented, are one of the largest components of inflation and the most difficult to remove from inflation. So that last percent that the Fed is trying to work down to get to its 2% target, a lot of it is still in the housing market. And you can see that in price charts. So the top is new home prices, and the bottom is existing home prices. So if there's going to be a housing rebound, and I do believe that there will be one, I think it comes later in 2025 into 2026, but there's nothing wrong with being ahead of that trend. We might be early, but if we want to find trends, we want to try to be ahead of the trend and identify when the best point to trade them would be, and or to enter as an owner, like owning stocks or ETFs, et cetera. Explaining these charts in just brief, you can see the massive spike in new home prices, now running on an average of around 490,000. But that is, although the prices have been declining slowly, they're still well above what the average annual growth rate in home prices would be based on the historical, your equity growth of 4.8%. That's sort of the long-term historical increase in housing prices. So we're still running well above 20 to 25% higher than would be normal in an abnormal sense and in an abnormal or following abnormal times. Existing home prices, however, are not following the same pattern. Existing home prices are still setting new highs. That's the market that really needs to reverse, because that gives the sellers who want to sell and want to move up the ability to sell an existing home without selling low, but more importantly, be able to buy a new home without the crushing high prices and higher mortgage rates. So there's a divergence here in the housing market, that you have prices at record highs still. You have higher mortgage rates, higher overall interest mortgage rates, and that's causing both a demand problem, and it's changing the supply in a sense on the new housing side, as builders are building fewer houses. And as that supply begins to weaken, you have to unlock demand at some point. So the 2024 trend in new housing is lower. I mean, you can see on the bottom chart, it's clearly slowing. This part of the market, the home building market, needs to find a bottom and reverse. So what I want to see is supply and demand be in a better balance. We don't have that. If we go back, you can see on the housing sales sides, you could still see spikes up, pull down, spike up, pull down on both of the charts. So that's demand being out of balance. And then even on price, we have spikes up, spikes down. So that's creating a problem on both the supply and demand side. So lower rates, sustainable prices. So even if prices pulled back, I don't call it 5%, maybe 10% from existing levels, I would look for that to start to unlock the housing market on the demand side. And as the builders have more confidence in being able to move new homes, that should then unlock the supply side. I have an ETF that I'll share with you here in a couple of minutes that can help you take advantage of the housing market, along with 5 other ETFs. So we'll be looking at those in just a minute. I want to close off the election issue questions, risks, benefits that I started last week, and I'm going to finish it up this week. Last week, we looked at risks. This week, we're going to look at benefits as they relate to Donald Trump's first term in office, and how they would play out or may play out in a second term. The first and to me, the most important point is the reauthorization of the 2017 tax cuts, which took effect in 2018. That reauthorization would be viewed as a positive by Wall Street because it would remove a level of uncertainty. And I will talk about that as we discuss risks under VP Harris in just a moment. Trump also executed substantial deregulation, which is always viewed as a positive by Wall Street. The most interesting thing, I think, in the last 30 days was, I think it's 30 days, Trump attended a crypto conference, which that was a first for him. During his first term in office, he was not pro-crypto. He was not high on crypto, didn't support it in any sense, did not support it. Just it was not a major point of his first term in office. But attending that crypto conference and telling the people at that conference that he loves crypto, recent disclosures, he showed he owns somewhere or holds somewhere in the neighborhood of $1 million worth of crypto. I think it was Bitcoin, but I wasn't certain, and I didn't have a chance to go back and double check that one. But we can always check the news and find that one. That's a major shift, and for people who support and follow him, that could be a trend to watch under a second term. Doesn't mean go out and buy it necessarily. Again, I have an ETF that can help you not necessarily have to hold or own crypto, regardless of whether you believe in crypto, like it, dislike it. Again, is there a trend that we may be able to use to our advantage as investors and traders? And I think there may be. One of the most important things to keep in mind from Trump's first term in office was broad sector performance to the positive. There was only one sector, energy, which was negative during his first term. And I'll come back to that in just a second. But as you look at the sector-based ETFs, which essentially represent the entirety of our economy in 2 different time frames, which I'll explain here in a second, there were significant performance values here. And the reason that I separated these into end of year 2019 and end of year of 2020 is obviously the impact of the pandemic. And in the energy market, to begin with, you can see that the energy was minus 18% through the end of 2019, but a further decline of minus 10% through the end of 2020. That's reasonable, given that the US economy shut down, shelter in place, people weren't driving, right? Only essential workers were driving. So gas demand was substantially lower. So that makes sense, right? There's a rationale that doesn't mean it was Trump's fault. It means that there was something that caused that further decline. The other reason for energy being negative in that term is price. Price of oil was low, output was lowered. Typically in the oil markets, you produce less when prices are low and produce more when prices are high. Makes sense that way, right? So it's understandable that energy as a sector underperformed because prices were low during Trump's first term in office, or were lower than they are now during his first term in office. What is strange but true is that clean energy, alternative energy, did better under Donald Trump than it has under Joe Biden. I found this to be surprising, this sort of sector reversal. I would have thought that energy would have outperformed under Trump. It didn't. And I would have thought that clean energy would have somewhat underperformed, but it also didn't. And I'm only measuring it based on an ETF, the ICLN, which tracks clean energy stocks, a small basket of clean energy stocks. And you can see the 57% performance through the end of 2019, and then a huge spike in 2020. Now, again, there's a rationale behind that, which is that period in time, roughly 2017 through 2020, saw some of the fastest growth among wind, solar, batteries, electric vehicles. That whole swath of sectors really accelerated their growth phases in those years. So in that sense, it's explainable and understandable. What's weird is that clean energy has performed poorly under Joe Biden, considering it has been a policy backbone for him, down 57%. But energy, on the other hand, is up 142%. The XLE is up 142%. Again, higher prices, higher output, more profits, more revenue, more profits for energy companies. So we can see this weird divergence between what we would think or what we might think and what's actually happened. Also under Joe Biden, the only other sector that has significantly outperformed, has somewhat outperformed, are financials. Financials have done better slightly than they did in the 17 to 20 period. But again, lower interest rates, less lending, lower lending, a number of factors that pressured financial stocks, which have not pressured them in the last 3 years, especially as the Federal Reserve has raised interest rates. Profits on loans are higher, profit margins on loans are higher than they were in the 17 to 19, 17 to 20 period. But as you look at this, it is important to recognize that as an investor, as a trader, there were certain sectors that significantly outperformed in that 3-year period. Technology, anywhere from 100 to 180%, depending on how you want to end assessment. Keep in mind that in 2020, people had nothing to do. Trading volumes increased substantially. Money flows into stocks and options increased substantially. We, Traders Reserve, contributed to that in 2020 when we started running Income Madness Week almost every month from March through the end of the year. So the number of people who were attending just our Income Madness Week events in those roughly 6 to 8 months was 3 times normal volume. And they were also very profitable because the market recovered rapidly. Market moved, lower and bottomed in late March of 2020, and then zoomed right back up. A massive V-shaped rally as the market sort of moved forward. And a lot of that was driven by massive inflows of investing and trading capital into the markets. Also, to Trump's benefit, people were putting more money into the stock market in that 17, 18, 19 period as well. Even though there were periods of volatility, there always are, but people had no alternative. That is not a Trump problem, meaning he didn't create that no alternative problem. There was no alternative. Interest rates were, you had zero interest rate policy until 2016. And even after that, low interest rates. So people putting your money in the bank didn't make sense. It's also that's also a period where 17, 18, 19, we had substantial increases in overall options volume. That has continued on into the early 2020s. So it makes sense that there were significant performances, but it's important to note that that was broad sector performance across the breadth of the economy. As well, consumer discretionary. People felt wealthier, they spent more, they bought things. To illustrate that point and a critical difference, consumer discretionary maxed that 2020 performance of 113% based on the XLY. The XLY since January 2021 is up only 11%. So that's the impact, that's the effect of both inflation and the Federal Reserve's policy to slow spending by consumers. And as debt has increased and people have spent less, where they're not spending is on consumer discretionary. So the question is, which candidate can unlock consumer spending to previous levels? Based on this, it may very well be Donald Trump. Technology, obviously a big winner. I was surprised that real estate didn't perform well in that period, but still up. So are we splitting hairs, right? But anyway, so that it is worth assessing both the risks and the benefits of either candidate. That now past performance, I know, doesn't mean anything for the future, but it is clear that the stock market did exceptionally well for Trump during that first term. Now, Friday, VP Harris released her economic plan. I'm only going to focus on a couple of points because they're the only ones that I really think have any extension to investing or trading to the stock market. Anything that was more socioeconomic, tax policy, I'm not accounting for here, not as a positive or a negative. I just don't see that it informs us as to where to invest or where to put our money. The most important benefits right now are selective versus universal tariffs. We talked at length about universal tariffs last week. Selective tariffs right now, if they remain in place as they are, is simply status quo ante, right? The market has already priced in the impact or effect of the existing tariffs that under the Biden administration, which were carried over. They were also, in some cases, increased or expanded, largely versus China. So electric vehicles, they expanded that to, I think, 100% to offset the damage to American electric vehicles. Legacy semiconductors, solar panels, areas where China doesn't play fair. We'll put it that way. But the market already knows that, and the market can already price that in. So the question is, will Harris retain the selectively enforced tariffs? If so, that's status quo. Nothing changes. And I think the most important word is uncertainty. Let's use that one. Anything that creates uncertainty or removes uncertainty is either a market negative or a market positive. So where uncertainty is removed, that's a positive, that's a benefit, because the market can price in, can act, Wall Street can forecast, et cetera. Anything that creates uncertainty is a negative, because now Wall Street has to alter projections, alter perceptions of either the economy at large or any sector or portion of the economy within. So the Fed independence, no question to me right now that Harris is not going to change anything on the Fed side. I don't know whether she will change out Jerome Powell in 2026 when his term ends, but at the moment, that's a status quo. That is not an uncertainty area. The biggest issue on the Harris side, and I cannot yet find any evidence of her speaking about the 17 tax cuts, is whether or not she would reauthorize them. And that is an uncertainty. And that has the potential for a negative effect because Wall Street has not priced in any change to corporate taxes or corporate tax rates. And that obviously has impact to revenue and earnings forward. And that impact in the 2018 period when they first were enacted was about a 12% change to revenue to the positive side. And those are tax revenue, not sales revenue. So keep that in mind. But any change in the corporate tax rate would be a substantial change that Wall Street does not have projected or priced in right now. The second thing, and the one that I'm concerned about, is interference in the free market. That is the price gouging. On the stump speech, price gouging, fighting price gouging sounds great, but prices are subjective. They are not objective. Governments in this country do not set price. They do not set profit margins. They don't set prices. They don't set profits. The consumer determines those things. Even in the products that we bring to you, you determine the price of those products, believe it or not, right? It's what the market will bear. That was partly the issue that I was working through last week with the price of eggs, right? Are the price of eggs rising because of price gouging, or are there other influences to the price of eggs or any other food item that a president can't control? And I think once you start going down this avenue, it's a problem to me. Again, it creates uncertainty. It's not the same as price collusion. That is, if all egg sellers were raising their prices the exact same amount, right? That would be price collusion. That's one thing. But an individual producer raising their prices 20 cents, is that price gouging, or is there a business or substantial or other mitigating factor causing an increase in price in the short term? So the argument on creating policy for the FTC to go after price gougers, how do you determine that? I think that's a question that needs to be answered. But that is a negative policy. It sounds great. We all want to get rid of inflation. We all want prices to go back to normal. How do you do that? Government interference is not the answer to me, where nothing illegal is taking place. I guess I should qualify it that way. The second thing is on the housing side. This is Trace's works backward to the housing data that we just reviewed. The $25,000 first-time buyer down payment assistance does not guarantee risks increasing home prices. Because if I'm selling a home, or if I'm a real estate agent, I'm going to bump the price up and then tout that first-time buyer down payment assistance to try to get somebody who qualifies in the door and sell that house at a higher price. That's a risk. It is not a guarantee. That I'm not predicting that would happen, but it is a risk. The second is that the core policy that she presented doesn't fully address the demand side problem, because that is a price problem, and that demand side problem is also affecting non-first time buyers. So again, we have a policy that's may help some people, but it's not helping all people. And the third thing is it risks decreasing supply in the short term, as either sellers wait for those policies to maybe take effect or be passed by Congress, or for the tax incentives that were offered for or presented, for builders of multi-tenant buildings, I believe is how it was phrased, for those to take effect. If you're a builder and the potential for tax incentives exists, are you going to build today or wait for those to become available to you and then build? So again, there is a risk of maintaining this imbalance in supply and demand in the housing market. How that plays out, we will have to wait and see. But knowing that those risks exist, balanced against the Federal Reserve's rate cutting policy, which is a benefit but not ascribe to either candidate. It's just it would eventually unlock the housing market, but we needed to take a look at how these we need to watch how these will play out. So I don't have, obviously, I'm not going to ascribe the Biden era stock market returns to Harris. She's a vice president. She's not the president. She doesn't direct or demand policy. So she's going to have to stand on her own in that sense. And I don't see it as a fair comp. Biden's policies are his. She is a supporter of those policies as the vice president. That's her responsibility. We all know that the market has been difficult for the last 3 years, and but at the end of the day, the main issue is not creating uncertainty, and these are the areas where I see that either no uncertainty, removing it, or adding it where I do see some risks. Doesn't mean the market's going to collapse, doesn't mean the end of the world. It means these are things that we need to watch and pay attention to. Which leads me to, where can you invest regardless of who wins in 2025? I am taking this as more of an investing approach, not a trading approach, because trading will change from month to month, quarter to quarter, even week to week. But if we look at certain ETFs, I think we could build a reasonable basket of ETFs, which would give us pretty wide coverage on what is possible in the years ahead, years ahead. And some of these I shared with the 10X Portfolio Club people back in April, and that's the top 4. And then I've added 2 more, and I'll briefly explain each of these. The RFV is the Mid-Cap 400 Value ETF. These are companies with solid earnings, cash flow, and price strength. So over a 5-year return on that one is run almost 100%, so almost doubling. So that's averaging just under 20% per year, CAGR, compound annual growth rate. The second one is CALF, CALF, for people who want companies that throw off cash. The Pacer US Small Cap Cash Cows, 100 stocks, is an excellent source for not only for an investment in and of itself, but also hunting for small caps. At some point, we saw this back in July when the Russell moved up 11% in 3 days. The closer we get to that rate cutting cycle, that will begin to unlock small cap performance. Small caps have been badly lagging the major indices, but that's going to change at some point. And this particular ETF has very positive performance, and by focusing on those small caps that are producing cash. That's why they call them cash cows. The iShares US Home Construction, ITB, 5-year return, 240%. Obviously, that's a little skewed because of the way that the market moved between 2020 and 2022. But even looking at the 10-year return of 400%, that's a solid 40% and average return over 10 years. Yes, we all want a piece of that. And if you agree that there is a housing boom coming, this is an excellent ETF to leverage or to use, in a portfolio to get a piece of the market without having to buy individual home builders or other, home builders, suppliers, et cetera. So it's an easier way to get broad exposure in the home construction industry for the potential of a home boom. Global X Artificial Intelligence and Technology, AIQ, 5-year return, 116%. Again, for people who don't have time to go hunting for individual stocks, this is an easier and simpler way to get a piece of the AI boom. However long it lasts, however it changes in the future, the performance of this particular ETF is, again, strong and positive, and makes it simpler for you to take advantage of a sector or segment of the tech market. We look back at tech under Trump, 100 to 180%. If you get those types of gains again, this ETF should significantly outperform in the years ahead. And it is not dominated by NVIDIA either. While NVIDIA is a part of it, it is not it's not like the only holding. You do get a broader exposure across the breadth of AI. iShares Bitcoin Trust. This traces back to the potential for a trend in crypto. I would view this more as a Trump ETF. If he's talking up crypto, or if he continues to talk it up, his followers will buy into crypto and invest in it. And that symbol is IBIT. It's important to note this is a brand new ETF. The SEC in December gave license to ETFs to create baskets of what you would call coin or crypto stocks. So that's everything from the coins themselves, Ethereum, Bitcoin, et cetera, to the holding companies, to the trading businesses. So it's a pretty broad exposure to the Bitcoin ecosystem. So there's no 5-year return. I think that one's trading in the 30s right now. Just below, a little bit below its 50-day moving average. I might wait till it's above its 50-day moving average. But it's not an expensive ETF. And most of these you should find have very low expense ratios, which is critical. So one of the reasons that is one of the reasons why I selected this group of ETFs. And finally, the iShares MSCI USA Quality Factor, symbol QUAL, 5-year return of 89%. Not necessarily anything to write home about. What is unique about this ETF is that it is covers a broad swath of the economy with quality stocks based on their measure for quality factor that should or are expected to outperform in a rate cutting environment. So we are about to enter that rate cutting environment, and that's why I added this one to my little list of 6 ETFs. So the overall, what this gives you is a pretty broad approach. You're covering value stocks in the mid-cap 400. Again, as interest rates decline, that should expand investment capital at the business level and decrease the cost of borrowing, both for small caps and for small to mid-sized businesses, and unlock more value in the middle of the stock market. That's small caps to mid caps. So that's the RFE and CALF. Obviously, home construction gives us access to the home building market, AI and technology, Bitcoin, and a basket of quality stocks across the spectrum of the indices. So that's the rationale across my 6. IQ income report last week was pretty busy. I've actually separated out income masters, so I'll do that on the next slide. But options income weekly closed out NVIDIA for a 0.6% return, $51 on $8,200 in a 4-day trade. SPX1 again, another win and another no stress win. I think we closed this one out relatively early. 4 contracts, another $300 gain, another 8% return. So that's 2 weeks in a row, following our small loss 3 weeks ago. So we are building up another winning streak. 5K challenge closed 2 trades, 2 straddles on the SMH and the XLK, both running about $4,600 in capital, both closing for gains of $700 across 2 contracts, 15% returns. That's how we've been targeting our options trades at the 5K challenge. We're targeting gains, that return anywhere from 10 to 20%, rather than collecting $1 and trying to get as much of that dollar. So some of the trades that we've been executing are a little bit different in that approach, but so far they're working very, very well. We had an MTC special event last Wednesday for attendees of the Millionaires Trading Club event in October. We had 2 trades that we put on that closed. The Applied Materials call spread that was $450 in capital for 3 contracts and an income of $300, 66% return. And then a Walmart trade, which is essentially a break even, depending on the people who were patient enough and waited until Friday, essentially should have been out at break even, plus or minus 15 cents. We paid $100 to get into that trade, and the credit out was about the same, about $100. So it was a $0 trade. Nothing good, nothing bad. Income Masters, very busy week, 9 closed trades, freed up more than $25,000 in capital for this week's Mini Madness event, over $3,100 in income. Meta Lilly, great article by Emily today on Eli Lilly, on how we've been trading it, and how we leveraged Lilly for a recovery trade. We were underwater on that one for a couple of weeks, and how we turned that into a profitable trade. Taiwan Semiconductor, Costco, JP Morgan, Tesla, Netflix, Humana, and Enphase. Enphase, if anyone didn't see it, closed roughly at the end of the day on Friday. I noticed members on the Discord channel reporting that their Enphase GTC good till cancel order was hit. But Dave didn't confirm that until after market hours, so that's why we didn't send the alert out until this morning. But again, 12.2% return on capital in those across those 9 trades, and the Mini Madness event starting this week. I will be first of all, I apologize for rescheduling or scheduling earlier today. Had to adjust travel plans as Liz and I are heading out of town, and everything got screwy. So thanks for joining me early today. I appreciate it. I will be out next Monday, and then the following Monday is Labor Day. So IQ will return on September 9th. And at that time, we're going to dive into the forward valuation levels in the S&P 500, hedging against disappointment in September. Remember, the Fed meets on September 18th, and that is the day that Wall Street is expecting that rate cut. And we'll also look at potential sectors to trade for Q4. And a reminder, Mini Madness, I believe that starts today, 12:30 for Income Masters people. So get your capital ready. It should be an exciting week. Millionaires Trading Club, we are rescheduling that September 18th event. We knew it was a Fed day. We didn't know how important it would be. As we have gotten closer to it, it has become much more important. So the Millionaires Trading Club, for originally scheduled for 9/18, will be rescheduled. I don't know if they gave everyone a date last 2 weeks ago. No, last week. Sorry, last week. But if not, we will make sure that we give you a heads up. Probably post Labor Day, we will let you know when we're looking at moving that to. Either the next week, the 25th, or the first week in October is our expectation right now. And finally, the pre-sale tickets for Investors Blueprint Live will go on sale later this week. Attending live or virtual, the pre-sale price would be $197. I'm working on an agenda and some pretty big ideas, so I'll be releasing those to everybody a little bit later this week. So that is IQ for this week. Good luck to everybody if you're attending Mini Madness. Outside of that, have a great week trading, and I will stay in touch with you via our email updates. Thanks very much. Have a great day.